Good morning, and welcome to the Bulls, Bears, and the Bell Morning Edition. Thank you for joining us. We're diving into what's really shaping up to be, well, one of the most consequential sessions of the year, I think. It is October 29th, 2025. And the global financial market is, you could say, literally standing right on the absolute cusp of a major new milestone. It's a market driven by this really profound technological enthusiasm, but at the same time, it seems almost paralyzed by policy risk.
That is the perfect framing for today. It's an acute convergence. We've been calling it a catalyst convergence. We've got the climax of corporate earnings season rolling in, a really high-impact policy decision coming from the Federal Reserve later today. And on top of that, active, very complex geopolitical shifts all hitting the wire pretty much in rapid succession. So our mission in this deep dive is really to quickly synthesize our sources. We've got detailed market analysis covering risk, strategy, opportunity, basically, to give you the essential playbook. How do you navigate this specific collision, this clash between, like you said, technological euphoria and the very acute macro uncertainty defining this morning?
Okay, let's try and unpack this high-stakes environment then. Our primary thesis today, I think, centers on one core: driving tension. It's this narrow, really intense investor euphoria, driven almost entirely by the relentless artificial intelligence narrative. That's one side. And on the other, it's battling this acute uncertainty thrown up by central bank policy, specifically the Federal Open Market Committee, the FOMC, meeting later this afternoon.
And you can see this tension reflected directly in the hard numbers even as we speak. The main U.S. stock market index, the U.S. 500, it's hovering right now around 608 points. That's showing a pretty modest pre-market gain, maybe 0.25% from yesterday's close. Now, that might sound stable, but it places the index right on the absolute cusp of its all-time high. That's 6915.18. It is literally breathing down the neck of a new record high, which tells you the baseline investor sentiment is still, well, overwhelmingly positive, or perhaps just really fearful of missing out,
Yeah, FOMO is definitely a factor. The index has been pulled this high by, well, sheer optimism and maybe just liquidity, right?
Yeah.
And now it feels like it needs permission. It needs a clear signal from the Fed to actually break through that resistance level.
Exactly. And that reliance, that dependence on external permission, that's what makes today so unique and, frankly, so risky. The risk is immense because the system's running hot, absolutely. But so is the potential opportunity. We really have to stress that the real action, let's say, the guaranteed source of market volatility today, it's probably not the anticipated headline rate cut this afternoon.
Okay.
It's what comes immediately after that announcement. We've got to look far beyond the headline number. We need to focus, really focus, on the fine print of the Fed's communication.
Right, the nuance.
Yeah.
So let's start with the engine, the propulsion system, if you will, the powerful force that's dragged the U.S. 500 up to this altitude. AI euphoria. This theme, it just seems relentless. And the market is clearly demanding and rewarding demonstrated execution. Real strategic scale right now. It's no longer enough to just talk about AI. Companies actually have to prove they're monetizing it.
It truly is an unstoppable momentum right now. You're right. And the market has very specific, sometimes very dramatic examples to latch onto that kind of confirm this shift. Just look at the NVIDIA story yesterday. That announcement came out about their, $1 billion investment in partnership with Nokia.
Yeah, with Nokia.
The market reacted instantly. NVIDIA surged 5% to another all-time high, just cementing its dominance in computational hardware. No surprise there, really. But the real eye-opener was Nokia. It rocketed an astounding 24% on that news. 24%.
Wow. A 24% move for a company like Nokia, which, let's be honest, has seemed like a struggling telecom equipment player for a while. That just confirms, doesn't it, that the market is laser-focused on funneling capital into companies positioned to actually capitalize on AI infrastructure. This isn't just about the chip makers anymore, is it? It's spreading out. It's about the enabling tech, the strategic placement of computing power.
Specifically, I think Nokia's massive jump validates its role in things like 5G and, crucially, edge computing. That's the infrastructure needed to run AI services closer to the end user, rather than relying solely on these huge centralized data centers. So that capital, it's flowing toward winners who can demonstrate they have established scale, real scale, in the physical delivery chain of AI.
And here's where it gets really interesting, I think. Moving beyond just the stock price gains, looking at the deeper, maybe structural impact, the impact that's kind of justifying these incredibly high valuations we're seeing. The market seems increasingly willing to justify these extraordinary multiples in the tech sector through the promise of, well, massive corporate efficiency gains powered by AI deployment.
Absolutely. And the sources of the data we're looking at confirm this transition is already well underway. We're seeing news headlines reporting that tens of thousands of white-collar jobs are disappearing, and that's across multiple sectors. It's happening as these new automation platforms are being implemented. Now, that might sound concerning from a societal perspective, definitely, but for the corporate balance sheet, for the CFO, it's a structural efficiency dividend.
That structural shift is the crucial detail, isn't it? Because for the corporate executive, for the investment committee, labor reduction translates directly into margin expansion,
Well,
often without needing massive top-line revenue growth to hit those profit targets. And this efficiency narrative, it feels like it's implicitly built into the high-growth expectations currently placed on these tech leaders. It helps validate, maybe, why the Nasdaq's valuations continue to, well, defy traditional metrics.
which brings us neatly directly to the handbrake, the other side of the equation, the FOMC crossroads, scheduled for this afternoon. So while AI is providing the propulsion through tech efficiency, the Fed is basically defining the entire liquidity environment, the rules of the game, so to speak.
Yeah.
Now, the consensus expectation for the rate cut itself seems crystal clear. Analysts pretty much universally anticipate a 25 basis point cut, a quarter point. That would shift the federal funds rate target down to the 3.75% to 4% range.
Right. And since that 25 basis point cut is largely priced in, as they say, by current market positions, the actual headline decision, when it drops at 6:00 p.m. UTC, it's likely to cause maybe limited sustained volatility. Unless it's a total shocker.
Well, it's probably yes. Unless I do nothing or cut by 50, the initial reaction might be muted.
So what is the real volatility risk today? Where's the aha moment for you, our listener, who wants to know where the true financial danger might lie?
The key volatility source is almost certainly not the rate cut itself. It's the forward guidance. That comes 30 minutes later during the press conference at 06:30 p.m. UTC. And specifically, the critical focus, where all eyes will be, is on quantitative tightening, or QT, and the future pace, the future endpoint of the Fed's massive balance sheet runoff.
Okay, let's spend a moment on QT because this feels important. We're talking about structural risk here, aren't we? Not just the cost of borrowing. Can you explain for the listener how this Fed's, was it $6.6 trillion test works? And why does the balance sheet runoff matter so much to the equity market?
Sure. So the Fed is basically engaged in this massive real-time liquidity experiment, or test, as you call it. Quantitative tightening, QT. It's the process where the Fed reduces its huge holdings of treasury bonds and mortgage-backed securities, the stuff they bought during QE, the stimulus periods. Now, crucially, they aren't typically selling these assets actively into the market. That would be highly disruptive.
Right.
They're mostly just allowing bonds to mature, to reach their end date, and then not reinvesting the principal, not replacing them on the balance sheet. And this process, passively, it absorbs liquidity from the financial system. It essentially removes cash from bank reserves.
And this isn't just abstract economic theory, is it? We're actually seeing some potential real-world consequences already.
We are seeing hints, yes.
So if the rate cut itself is seen as dovish, as supportive, but the guidance on QT, on the balance sheet, sounds hawkish, sounds restrictive, which signal wins out?
The QT signal wins almost every time. Because liquidity risk, the availability of cash in the system, that's the foundation upon which all asset prices ultimately rest. Our sources, the things we're tracking, are pointing to some lingering signs of funding pressures in key overnight lending markets, repo markets, for example.
Okay.
These markets rely on sufficient bank reserves to function smoothly day to day. So if the Fed signals an unexpectedly aggressive pace for QT, maybe shrinking the balance sheet faster than expected, or perhaps an unexpectedly long duration for QT, meaning they intend to keep shrinking it for many more quarters. That inherently tightens financial conditions regardless of that little 25 basis point rate cut.
Right, it's like giving with one hand and taking away much more with the other.
Exactly. That structural drain, it elevates the chance of a sudden, maybe sharp market repricing. Any unexpectedly hawkish language from Chairman Powell on QT this afternoon, it could trigger an immediate sell-off, completely overriding any good news from the rate cut itself.
Wow. Okay, so that structural risk, the possibility of a liquidity squeeze from QT, that sounds like it's profoundly compounded by the fundamental fragility underlying the U.S. market's record high level right now. We keep hearing analysts call it fragile, narrow leadership. What does that actually mean in practice?
It means the market rally is defined by dangerous concentration risk. It
Oh,
really is. It's concentrated almost entirely in those handful of mega cap tech stocks, the Magnificent Seven, maybe throw in a few chip stocks benefiting directly from the AI narrative. So if the Fed does spook the market with QT talk, there's really no depth beneath those top few names to catch the falling indices. The broader market isn't participating in the same way.
and the statistics here, they're genuinely telling, aren't they? Our sources indicate that just yesterday, on the previous session, although the S&P 500 gained, what, 0.2%, and closed at an all-time high, that's the headline everyone saw, almost 400 of its components actually recorded a decline, 400 stocks.
That is pretty much the statistical definition of extreme narrowness. It's quite stark. It means the overall index level, the number you see on the news, is a highly fragile barometer of broad market health. If we were looking at, say, an equal-weighted version of the S&P 500 where every company has the same influence, regardless of size, the headline yesterday would likely have been a decline, not a record high.
Right.
The standard index, the cap-weighted one, means that when giants like NVIDIA or Microsoft or Apple move up even a little bit, their sheer size masks the pain being felt across, well, maybe three-quarters of the rest of the U.S. economy represented in that index. And that makes the entire rally profoundly vulnerable to a policy shock, particularly from the Fed's QT guidance later today.
Okay, let's trace how this AI theme and the policy uncertainty surrounding it are affecting global flows, because the benefits are clearly not being felt uniformly internationally.
No, absolutely not. It's a very uneven picture globally. Asia, primarily driven by its big technological manufacturing hubs, is showing more resilience. Japan's Nikkei 225, South Korea's Kospi, they led gains recently. They're specifically benefiting from Asian chip stocks, think SK Hynix, Advanis Corp. The positive reaction over there to the NVIDIA Nokia news confirms that this AI capital flow is truly global. It's providing a powerful structural tailwind, but only to those nations really positioned within the technology supply chain.
But then you travel across the continents, you look at Europe,
Yeah.
and the picture changes dramatically, doesn't it?
Yeah, European markets were generally flat to maybe slightly negative in recent sessions. This really reflects deep, localized economic conditions there. They seem to be struggling to overcome the broader macro headwinds, even with that AI tailwind blowing globally. We're seeing pretty sustained evidence of localized weakness, particularly in Germany. German consumer sentiment, for example, has returned to a worsening trend. It sank back to its lowest level since April. And that seems due to persistent high inflation there and just generalized geopolitical uncertainty impacting confidence. The optimism driving the U.S. market simply hasn't permeated the core European consumer yet.
Okay, now let's look at a potential hedging indicator, commodities, because they can sometimes tell us what institutional investors are really doing, especially when they're wary of equity euphoria and this kind of concentration risk.
And the signal from gold, well, it's flashing caution in bold letters right now, wouldn't you say? Gold futures have rebounded quite significantly. They bounced aggressively off those consolidation lows we saw just yesterday, now trading near $4,024 per ounce. That's a gain of over 2%.
A plus 2.13% jump in gold. Yeah, that feels like a classic institutional liquidity hedge, doesn't it? It suggests that despite the sort of risk-on attitude dominating the Magnificent Seven stocks, large money managers, the big players, are likely maintaining a substantial non-correlated hedge, a hedge against exactly what we've been talking about, market structure fragility, and those looming liquidity concerns tied to the Fed's QT program. They seem to be betting that if volatility really spikes, traditional assets might break down, correlation goes to 1, and gold might hold its value better as a safe haven.
Exactly. Meanwhile, WTI crude oil, that's West Texas Intermediate crude, it seems to have stabilized around $60.33 per barrel. It gained a modest 0.30% after declining for 3 days straight. This suggests maybe that traders have discounted the immediate sanctions-driven supply shock fears we saw flare up last week, and perhaps they're refocusing back on the longer-term supply and demand fundamentals.
And that stability is really critical, isn't it? Because instability in oil prices, especially sharp spike upwards, is one of the few factors that could instantly undermine the Fed's entire premise for cutting rates today. It would just re-import inflationary pressure right back into the system.
Absolutely critical. Oil stability is a key permissive factor for the Fed's expected dovish move today.
Okay, speaking of immediate factors, let's pivot now from the high-level macro policy discussion down to the micro catalysts. We had a substantial slate of major corporate earnings released before market open, or BMO, today. But the institutional reaction seems to have been generally muted across the board. What does that tell you?
Yeah, it signals that caution is really the order of the day ahead of the Fed's big announcement at 6:00 p.m. UTC. The market is effectively on hold, it seems. But that muted reaction shouldn't completely mask the deep scrutiny being applied to specific industrial and aerospace names, particularly because they have some, let's say, unique valuation anomalies going on. The market seems to be using these earnings calls primarily to gather intelligence on two key themes: global trade stability, and maybe just operational credibility.
Okay, let's start with the industrial giant, Caterpillar, CAT. The consensus EPS forecast was $4.52, which is actually, interestingly, a year-over-year decrease. But the market seems to be giving it this enormous valuation premium for its future potential, right?
Absolutely. CTA's forward price-to-earnings ratio looking out to 2025 sits at a very high 29.56. That's significantly above the broader industry average, which is around 21.30. This enormous valuation differential implies massive expectations for accelerated future growth. Growth that, right now, kind of defies its historical industrial cycle sensitivity.
So why does the market justify that premium? What's the thinking there?
Well, it seems purely tied to two things: geopolitical optionality and its inherent business mode. Caterpillar stock isn't just pricing in a simple, straightforward trade deal between the US and China. It feels like it's pricing in the unleashing of global infrastructure and mining spending after a deal gets done, especially in emerging markets and maybe related to US infrastructure initiatives too.
Hmm.
Plus, its heavy equipment products are notoriously difficult to substitute. That gives it strong pricing power, even in tougher times. However, with its PE sitting nearly 40% above the industrial average, the market has basically zero room for disappointment on that trade front, which probably explains why the stock only saw that modest pre-market gain of just plus 0.63%. It's tightly constrained by the overarching macro uncertainty waiting for that geopolitical signal.
Right, so the stock is priced for a perfect trade deal outcome, essentially,
Yeah.
which puts enormous pressure on those talks happening later this week. Okay, now let's look at Boeing. BA, that feels like a special situation entirely, focused more on operational turnaround than current earnings, wouldn't you say?
Definitely. Boeing reported an expected net loss of $2.46 per share, but here we see just extreme valuation dislocation. BA's PE ratio is highly negative. It's at a shocking negative 53.48. Compare that to an industry average PE of around 5.0. This deeply negative PE is really the definitive sign of a company perceived as distressed, but perhaps in a recovery phase. It tells us the market has completely abandoned standard earnings metrics for Boeing right now.
And yet the stock reaction was near flat this morning. Why no big move on that loss?
Well, the marginal pre-market gain, just plus 0.06%, it tells us two key things, I think. One, clearly, that loss was fully priced in. It didn't surprise anyone. And two, investors are focused entirely on non-financial metrics now. Things like management guidance regarding manufacturing stability. Can they fix the production issues? Also, cash burn reduction. And critically, hitting those aircraft delivery schedules. The market is not trading on the reported financial loss. It's trading on the credibility of the turnaround plan. Any communication out of Boeing that suggests a clear, sustained path back to operational stability, that could trigger a significant short covering rally, especially given that extreme negative valuation context. Lots of people betting against it.
Okay, interesting. Shifting to some other key sector reporters from this morning. The fintech giant Fiserv, FI, actually showed distinct strength despite the generally cautious mood out there.
Yes, Pfizer registered one of the strongest positive BMO reactions we saw, up plus 0.82%. Now, this is an important, maybe high signal indicator because it suggests continued robustness in enterprise spending on digital transformation, specifically within financial services. It seems companies, especially banks, payment processors, they're clearly still prioritizing and investing heavily in upgrading their digital backbones. And they're doing it regardless of the Fed uncertainty or general macro fears out there. That spending seems pretty resilient.
Okay. On the other hand, though, we saw some weakness despite what looked like robust growth expectations from CVS Health, right?
Yeah, CVS was actually expected to report a very strong year-over-year EPS increase, almost 25%, a big jump. Yet the stock traded slightly lower in pre-market activity, down about negative 0.09%. Now, the PE ratio for CVS is around 12.96, which is actually higher than many of its industry peers.
Oh.
So this means the market has already factored in a pretty significant growth premium into the stock price. To validate that higher valuation, the market demands more than just a meeting expectations quarter. It needs a significant strategic beat, or maybe extraordinarily strong forward guidance to push the stock higher. Simply meeting expectations often isn't enough when you already trade at a premium valuation.
Got it. The bar is set higher. And finally, just a brief mention of Verizon, VZ. They were pretty much flat to negative this morning.
Yeah, VZ was flat to negative, down about -0.03%, despite reporting basically flat EPS year over year, which was expected. The context here really is the recent major leadership transition. They appointed the former PayPal CEO, Dan Schulman. The market just remains inherently skeptical following such a high-profile change at the top. And it's basically waiting for clear strategic direction from the new management team on critical issues like, subscriber retention, 5G monetization, capital expenditure efficiency. Flat results today just mean the jury is definitely still out on the new management's vision and their ability to execute.
Okay, let's broaden our scope again now, back to the forces driving the global macro environment. Starting with arguably the biggest positive geopolitical driver out there right now. That anticipated U.S.-China trade deal signing. It's expected between President Trump and Xi Jinping later this week in South Korea, right?
Yes. This high anticipation is really the primary geopolitical tailwind supporting global market futures at this moment. That optimism is what's supporting cyclical stocks. Think back to the enormous expectations built into Caterpillar's valuation we just discussed. And we actually seen concrete evidence of action already. China apparently purchased 3 cargoes of U.S. soybeans just ahead of the summit. This confirms that these positive trade expectations are influencing immediate commodity purchasing decisions and global trade flows right now.
But the volatility layer here, as always seems to be the case with these complex negotiations, involves the politically charged sort of non-economic subjects. This is what could potentially cause a rapid reversal of sentiment, couldn't it?
Exactly. The discussions are reportedly far more complex than just tariffs and soybeans. They include these really politically charged topics like the export of chemicals used to produce fentanyl, which is a huge domestic issue in the U.S. The inclusion of these non-economic issues adds significant volatility because, for the U.S. side at least, they might be seen as non-negotiable domestic policy priorities. So failure to reach a concrete agreement on those points, or even the introduction of unexpected friction related to these sensitive issues, that could lead to a very rapid reversal of the current geopolitical optimism that's underpinning cyclical asset prices.
Okay, which leads us maybe to the other big geopolitical risk factor. The crucial and very complex energy dilemma regarding Washington's sanctions on Moscow. This feels like a key external risk the Fed really can't control but has to react to.
It's a genuine policy tightrope walk. Policymakers in Washington have to try and enforce tough sanctions against one of the world's top oil producers, Russia. But they have to do it without inadvertently triggering a major supply shock that immediately inflates energy prices for their own domestic consumers. It's this constant conflict between foreign policy objectives and domestic economic stability needs.
So what's the tipping point for the market here? What should we be watching for in oil?
The tipping point is really the sustained stability of WTI crude. It's currently holding around that $60.33 mark. If political enforcement actions, or maybe escalating geopolitical tensions, lead to a sudden, sharp, sanctions-driven spike in crude prices, let's say, pushing it rapidly up towards $75 a barrel, the global inflation outlook would instantly be recalibrated upwards, very quickly. And such a move would generate intense pressure on the Federal Reserve to maybe pause or even reverse its currently expected rate cut trajectory. It would create significant macro instability by basically forcing the Fed into a much more hawkish corner than they want to be in. So the stability we are seeing in oil right now is actually essential for the Fed to feel comfortable justifying its expected cut later today.
Makes sense. Now, we should also probably briefly touch on 2 critical long-term structural shifts that might be flying a bit under the radar amidst all the immediate FOMC excitement.
Yeah, good point. First, globally, we are seeing significant economic divergence continuing. It's not a synchronized global picture at all. For instance, we just got data showing Australian inflation has surged back above the Reserve Bank of Australia's target band. That's basically eliminated any prospect of an interest rate cut down under in November. It just shows that disinflation, the cooling of price pressures, is not a uniformly distributed global phenomenon. Policymakers around the world are facing very different domestic inflation challenges right now.
And the second big structural shift involves China's massive longer-term pivot, right?
Yes. China's communist leadership has pledged this major strategic shift over the next 5 years or so. They want to pivot towards consumption-led growth, allowing household consumption to play a much greater role in driving their economy, moving away somewhat from that heavy reliance on infrastructure investment and exports that characterized the last few decades. Now, If, and it's still an if they are successful, this is a profound thematic signal for global investors. It could fundamentally alter the long-term demand profile for global exporters and resource providers. The focus might shift away from companies that support industrial build-out, like miners and heavy equipment makers, and shift towards companies more exposed to the burgeoning Chinese consumer market. This is a multi-year transformation that requires constant tracking.
Okay, let's bring all this back down to strategic takeaways for today then. Starting with what looked like some compelling tactical opportunity revealed earlier this morning in the UK economy.
Yeah, the UK domestic economic data releases for September actually offered some compelling evidence of consumer resilience over there. And it stands in pretty sharp contrast to the localized European weakness we discussed earlier, particularly what we're seeing in Germany.
Specifically, the figures were quite strong, weren't they? Mortgage approvals hit £65.94k, substantially beating the consensus estimate of 64k. And even more compelling, maybe, net lending to individuals came in at £7.0 billion. That was significantly higher than the £5.5 billion consensus expectation.
Right. This strengthened UK consumer balance sheets, evidenced by robust borrowing and housing market activity. It actually reduces the immediate necessity for the Bank of England to pursue aggressive easing measures. And it provides some structural support to the sterling to the pound. So for investors looking for relative bright spots, this suggests there might be selective long opportunities in UK domestic sectors. Companies that benefit directly from consumer spending and credit availability. It could provide a valuable strategic buffer against those broader continental European slowdown fears. It seems like the UK consumer kind of missed the memo about the recession everyone was expecting them to have.
Interesting. Now, before the main event, the Fed decision and press conference, we do have a few midday U.S. indicators coming out later. They'll provide some valuable context on the current state of the U.S. economy just before Powell speaks.
Yes, exactly. We're looking closely at pending home sales. That's out at 2:00 p.m. UTC. That'll give us a gauge of housing market resilience after the recent interest rate volatility. Consensus is expecting modest 1.6% month-over-month growth there. And then at 2:30 p.m. UTC, we get the EIA crude oil stocks change data. The expectation is for a modest drawdown, about mid of 0.4 million barrels. If that's confirmed, or maybe even a larger drawdown, it would reinforce the current stability of WTI prices near that $60 mark, which, as we discussed, helps alleviate some immediate macro stress for the Fed.
But really, when it comes down to intraday strategy today, the timing around the Fed decision is absolutely everything, isn't it? We need to be laser-focused on disciplined risk management based on the official timeline.
Exactly. So here's the timeline you really must focus on this afternoon, leading up to 6:00 p.m. UTC. Maintain disciplined, probably conservative positioning. Current stock index futures look a bit inflated by that AI euphoria and the expectation of Fed dovishness. It's probably wise to limit exposure to high beta growth stocks, particularly given the concentration risk we highlighted.
Okay. Then we hit the official announcement time itself.
Right, at 6:00 p.m. UTC, the rate decision. Expect limited volatility unless the decision wildly deviates from that consensus 25 basis point cut. Most institutional managers will likely already have this outcome reflected in their portfolios. The algorithms might react for a few seconds, but sustained moves are less likely just on the rate number itself.
And then the critical hour, the part that will likely define the rest of the trading week, maybe even longer.
6:30 p.m. UTC, the press conference. This is the moment. Institutional focus, your focus, must shift entirely to Chairman Powell's language, specifically regarding the pace and the expected duration of the quantitative tightening runoff, the balance sheet. It would be prudent to hedge high multiple growth exposure until this guidance is fully released and digested. If Powell sounds unexpectedly hawkish on QT, maybe indicating a faster pace of reduction or a longer duration than the market currently expects, a sharp, immediate market correction is highly probable as liquidity expectations are repriced downwards.
Okay, so synthesizing all this, the corporate earnings, the macro picture, the policy risks, what's our sector positioning summary for today, acknowledging this intense underlying tension?
Well, technology, media, telecom, TMT probably remains an overweight sector, just given that undeniable AI momentum. But, and this is a big but, it must be actively hedged due to the extreme concentration risk we've discussed, especially heading into the really major tech earnings later this week from Microsoft, Alphabet, Meta, Amazon, and Apple. That's a huge concentration of event risk, too.
Right.
Financials look neutral to perhaps slightly overweight. Strategically, favoring those UK-exposed institutions might make sense, given they seem to be benefiting from the domestic consumer strength we just discussed over there.
And what about the trade-sensitive cyclicals, like Caterpillar that we talked about?
Industrials and aerospace remain a selective overweight posture. but it's entirely contingent on those geopolitical developments playing out positively. Favorable outcomes in the Trump's-Relation trade discussions would likely be needed to propel stocks like Caterpillar out of their current holding patterns, given their valuations. Boeing, though, as we said, that's different. It really requires concrete, positive directional guidance on its operational stability to warrant increasing exposure significantly. It's still very much a show-me story.
Okay. So wrapping up this deep dive, it really confirms the market is fundamentally being pulled in two powerful, almost contradictory directions right now. You've got the powerful, very focused updraft from AI driving efficiency, driving margin expansion narratives, and that's battling against the global drag and, crucially, the liquidity risk defined by central bank policy, particularly the nuanced language around quantitative tightening.
It really is a fight between structural innovation on one side and structural liquidity conditions on the other. And, that leads us right back to that core story we identified earlier about AI driving corporate margins, partly through the elimination or displacement of white-collar labor. We noted that technology seems to be fundamentally shifting corporate gains towards efficiency, rather than relying solely on traditional top-line revenue growth.
So what does this all mean for the valuation metrics we typically rely on? The ones that kind of anchor the entire financial system, like the PE ratio.
Well, this raises a really important and maybe final provocative question for you to consider as you watch that Fed press conference unfold later today. If technology fundamentally shifts how corporate gains are generated, if it allows for enormous profit generation with significantly less human input, does the old metric of the price-to-earnings ratio, the PE ratio, which was largely designed for an economy where growth was often more linear and labor-intensive, does it accurately capture the future value of these AI-leading companies? If the very definition of a growth stock is potentially changing, maybe becoming one that delivers maximum profit with minimum headcount, perhaps we need a wholly new framework for valuation altogether. Maybe investors will need to start measuring things like productivity per employee or even productivity per computational unit, rather than just looking at profit relative to earnings or sales. Are we, in fact, witnessing the very definition of a growth stock change in real time before our eyes?
A fascinating structural shift to watch indeed, something to really mull over. Thank you for diving deep with us today. We'll certainly be watching that QT guidance very, very closely this afternoon.